Hello, everybody. Welcome to another episode of our Trusted Service Provider Expert Series. I am Johanna Chesbu. I'm your Director of Vendor Management here at CAMS, and we are joined today with Eric Bregman. He's CPA at Earney and Company, or Earney and Associates. Eric, can you introduce yourself and tell us a little bit about what we're going to discuss today?
Yeah, absolutely. So my name's Eric Bregman. I am an assurance partner at Earney Accountants and Advisors. I am also the practice leader for all of our HOA work, which includes both the assurance side as well as the HOA tax side, which is what we're going to be talking about today. So I'm going to spend a little bit of time hitting some of the high spots and providing some information, as well as giving a few pieces of information that are kind of need to know for you before the end of the year. As we're getting close to being in the fourth quarter of the year, it's crazy how quick this year has gone. So there's things we want to think about tax-wise as we go into the end of the year into next year.
Absolutely. And this is perfect timing too, because as a community manager, our CAMS deadline for selecting your CPA for tax filing is the end of October. So we're getting close to that. I appreciate you wanting to connect with us so we can learn a little bit more and make sure we have an educated decision once we get to that point.
Absolutely. So I'm going to go ahead and just jump right into it. All right. So once again, you can see my name's Eric. We're going to just jump right into this.
Thank you.
Guy pulling his hair out, which is basically what tax is all about these days, it seems. So these are just a couple things. Yeah. So these are just a couple things I'm going to go to, some of the issues related to association taxation, as well as just some general information regarding tax here. So I have a little picture here reminding everyone that the IRS always gets theirs. They're always going to get theirs. So
clever.
All right, HOA taxation. So this is the HOAs are the only entity that gets to choose which tax return that they file. And we'll talk about those here shortly. But an HOA gets to choose each year, whether it's an 1120 or 1120H. They get to only choose once a year. So if you do an extension with one form, you have to file with that form, but you can also change each year. So once you're do one year, you can change it the next year if the situation arises. Talking about the 1120H or the long form, as I mentioned. All right, so the first one is the 1120H, and there's a lot of information on this slide. I'm not going to spend a whole lot of time in the interest of time going through all this, but the 1120H is the form that most associations fill out. It's governed under Section 528. It is a one-page tax return. It is a 30% tax rate on non-exempt income. There's a $100 standard deduction that automatically gets applied. There's a very low risk, and our prep cost for one of these forms is $450. We've been doing these for $450 for over 10 years now. Regardless of the complexity of an association, if they fill out an 1120H, it's a $450. These are very simple returns to do. As I mentioned, there's some tests to determine if you're allowed to fill out that form, but I'm not going to spend a whole lot of time going over that because most associations, it's never an issue.
Most associations would qualify for that.
Correct.
And I wanted to stress too that the 450 also includes your ability to connect with the community manager as well as the board of directors. Should they have questions they need to consult on prior to making that decision. Is that right?
That's correct. You know, when an association that uses us for their tax prep, yeah, we do their filing for them, but we're also a year-round partner and resource should they need us for any tax advice, tax planning, tax questions, whether it's the community manager or the board of directors. We are happy to have those conversations, and we do not charge for those conversations. It's a year-round partnership for when we do that.
That's fantastic.
So let's talk about the things in the HOA world that are taxable. The vast majority of revenue for an HOA is assessments, dues, et cetera, but there are things that are taxable, and these are in no particular order. of commonality, but I'm going to go through them anyway. So fees charged for services to members. This is members or non-members actually. So if you have a clubhouse that you rent out, that could potentially be taxable. Swimming pool guest fees. If you charge a fee for a guest to come to the pool, that would be potentially taxable. Easements. This seems to be in our area in southeastern North Carolina, seems to be a thing nowadays with all the development where governments are buying pieces of land from homeowner associations to put roads in or whatever it is. The revenue that you get from easements is potentially taxable.
Okay.
Advertising agreements. If a company wants to advertise to the association and they're paying the association to advertise, that would be considered potentially taxable as that is non-exempt or non-member. Foreclosure sales. If the association were to purchase a property from a private owner and then turn around and sell that property, that revenue would potentially be taxable. Litigation proceeds. That's kind of getting in the weeds. That there's a lot of depends when it comes to litigation proceeds, but most importantly is earnings on cash and investments. Interest rates on CDs are still very favorable, as well as low risk investments. So associations that have a lot of excess capital tied up in that earn a lot of interest, that's going to be subject to tax. And that is by far the most common taxable source of revenue for the vast majority of associations.
What about late fees and violation fees?
Those are considered exempt function or member, so those would not be subject to tax.
Good to know.
So let's talk about the other choice. So this is the Form 1120. The Form 1120 is a standard business return, or I refer to it as the long form. This is used in situations where you have a very large association that has a very, very, very significant amount of non-member or non-exempt income, $50, $60, $70, $80,000 of interest income. They have significant rental income. They sold a piece of property, these types of things. There's an advantage to those associations filing this Form 1120. I want to note that for commercial associations, regardless of size, this form is a requirement for those type of associations, and commercial associations also are required to pay franchise tax.
Okay, so there's no choice for commercial property. It is the long form.
Yes. Yeah.
Okay.
Yeah, and we talked about those tests earlier for
Yep.
the 1120H. If they don't pass those tests, then they would have to do this form. The good, well, it's a 21% tax rate, so that's good. So if you have $100,000 of potentially taxable income, the difference between 30% and 21%, I mean, that's
It's
a significant.
significant.
Yeah, I mean, it can save thousands of dollars potentially to an association by filling out this form. The bad, it seems like there's more bad than good, but it is more complex. There is a higher risk of audit with the IRS. There's a higher prep cost, which is around $1,000 to $2,000 because of the additional time it takes to do that. And I do want to point out that you must do the 70-604 election in order to do an 1120. And I'm going to spend a little bit of time talking about that because this is important as we get close to annual meeting season.
Yeah.
That if you are an association that is very large and you feel like you are going to need to do that long form return, you need to make sure that the 70-604 election is part of what's approved at your annual meeting by the homeowners. There's no form or anything you need to fill out with the IRS. You just need to have it documented in the minutes of your annual meeting that the homeowners have approved the 70-604 election. And just in layman's terms, the 70-604 election allows the board of directors to use excess operating funds the next year.
And it's just something where they make a motion at the meeting and it's accepted and
whatever
recorded
the quorum
in the minutes.
Correct. Yeah, correct. And so, as I mentioned, there's no form that you need to fill out. It is just a motion at the annual meeting. But it is important, should an association file a long form and should they be audited by the IRS, The IRS
They
is
have
going
that
to want to see,
documentation.
they have the documentation of the
For sure.
7604 election. So just keep that in mind as you get into annual meeting season. My personal association, we are doing it this year, and we're doing it part of the budget approval process at our annual meeting this year. So I just wanted to spend a little more time on that than I normally
Yep.
would because of where we are in this time of year.
And I see you have the range of 1,000 to 2,000. I imagine that would be, you would provide custom pricing based on the needs of that community size and what type of tax filings they're looking at.
Yeah.
Okay.
And with the, yeah, and as I mentioned, there's more complexity with those returns because it is a standard corporate return. There's a lot more information. There's a lot more other considerations that we have to take into account, and it takes more time. So, but yeah, we would give a customized quote between that range depending on what they have going on.
And similarly to the 450 for the other form, that includes their ability to connect with you, have board meetings, ask questions throughout the year. Correct?
Yes,
Yeah,
that's correct.
okay.
Yeah, same thing. Year-long partnership. We're available, and usually when associations that have that type of situation, being that they're more complex, usually our interaction with them tends to be a little bit more just because of the complexity of their tax situation. So
Understandable, yeah.
okay, so talk about estimated payments. The question really is, should you make estimated payments? And the answer is yes. Now, I wish it's simple, but it's not. So if your association, regardless of what form you filled out, should consider making estimated payments during the year for your tax liability for the year. So you should be making estimated payments for 2024 taxes during 2024. Now,
is that to help so that it's not a big hit at the end of the year, or?
it's because it's required by the IRS.
Okay.
And it's to prevent late payment penalties potentially. Now, I say all that to say that sometimes it doesn't always make sense to make those estimated payments. Number one, you may not know what you're going to have as far as tax liability. So let me start with the long forms. If you file an 1120 long form, we will provide the association a vouchers for estimated payments throughout the year. That comes with that. And you should be making estimated payments approximately to what your previous year tax liability was. For an 1120H, the politically correct answer is that yes, you should make estimated payments. However, sometimes it doesn't make sense because if you only paid $100 in tax, it may not be worth going through the effort to do it, and it might just be worth paying whatever you owe when taxes are filed.
Yeah.
But the IRS says that you need to do it. So my official answer is that you should do it.
You need to do it.
You need to do it, yes. But the question is how much do you do? It should be similar to what you paid in tax last year. Now, we're at a situation now where potentially the interest you earn on your cash might exceed the penalty that the IRS is going to give you for, a late payment penalty. But each association has to weigh that risk on their own. It just depends on what they want to do. But for the large associations that file the 1120s, they need to be making those estimated payments quarterly in accordance with the schedule that is provided.
If for whatever reason it's an overpayment, is that shored up at the end of the year that they will expect a refund?
Yes, we can. Correct. Yeah, we would either have it as a refund, or we would apply it to the following year's return. Yeah,
that makes sense.
Yep. So anyway, so that's all I had for this one. Keeping it quick. I thought this was really funny too. That you can always achieve a quorum by proposing a large special assessment. You can get a lot of people to come to the meetings.
That's one way to do it.
Yeah, little HOA humor here, but anything else you think I need to communicate in this presentation?
No, you hit the nail on the head. short and sweet, and perfect timing too. As we dive into annual meeting season, we're kind of out of budget season now, but coming up to thinking about our tax filing. So I really appreciate you taking the time to connect with us again today
Absolutely.
and educating everyone on the benefits of having it done professionally and proactively. And thank you.
Yeah, no problem. Thank you.